Thanks for joining us today. I'm John Roberts, AO's founder and CEO. Although it's 10 years since our IPO, I thought it might be useful to set out some of the basics for those who haven't followed our story. AO began with a £1 bet back in 1999, and that's relevant because we've been doing this for a long time. Over the last 24 years, we've made a lot of mistakes. We've learned a lot of lessons. We've disrupted and reinvented an industry. And we were the fastest electrical retailer in the UK to ever get to £1 billion of sales. We are customer obsessed, and we've invested heavily behind the concept of vertical integration. Culturally, we live every day to treat customers as if they were our own gran and to make decisions that would make our mums proud. This has enabled us to innovate, to deliver concepts for customers that we take for granted today, but that didn't exist 20 plus years ago. From next day delivery, weekend deliveries, specific time slot deliveries, premium installations at the time of delivery, with our full range available on all those services. Brilliant online product information and fully shoppable across desktop and mobile. We control all logistics operations in-house, and we have about 1.5 million square feet of warehousing in the UK, enabling us to carry an unrivaled range and depth of stock that's available for next day delivery pretty much anywhere in the UK. We do this largely on our own fleet of AO branded vehicles with our own driver teams, meaning we can control the whole brand and service experience. We've also invested heavily in our own recycling capability, which is now the biggest and most advanced fridge plant and plastic refining operation in the UK. And as part of this, we're still on a mission, and hopefully we'll soon be able to sell fridges made from fridges and washing machines made from washing machines. When we IPO'd the business in 2014, our key objectives were to expand beyond selling major domestic appliances, which are cookers, fridges, freezers, washing machines and so on, into becoming a full-service electrical retailer, as well as internationalising the business. Our expansion into Germany didn't go to plan, but we learned a lot of big lessons for the future. In the UK, our category expansion is a longer journey than we had hoped, but then nothing brilliant was ever built overnight. It's unquestionably a key part of our growth engine to capture more share of wallet from our customers as we deepen our loyalty with them, a topic that I'll return to in our results presentation shortly. At the very heart of our business, our true difference is not what we do, but how we do it. And behind that is the culture, passion and pride of over 3,000 staff, our AOers as we call them, who are magic in the moments that matter for customers every single day. I've yet actually to meet a fund manager with an empirical way of factoring the value of that into a company. But still being a founder-led business, my strongly held view is that it really, really matters. And it matters more in the tough times in reality than the good times, as you'll see shortly in Mark's presentation. Through 2022 and 2023, we pivoted our business to a post-COVID world, focused on profit and cash generation, and we've now successfully delivered that pivot, albeit driving constant efficiencies is always a continuing journey. Today, as you'll see shortly, we're a business doing just over £1 billion of sales and making over 3% PBT on a journey to 5% PBT. We operate about 750 vehicles a day, have served a customer base of over 11 million, and with world-class Trustpilot scores based on over 500,000 reviews and a Trustpilot score of 4.8 out of 5. We also have meaningful businesses across all important categories now, from mobiles to TV sales, consumer electronics and small domestic appliances, but with huge opportunity to go. Getting to scale is hard by design. Learning the lessons takes time and money. The road is uncertain, and the scale and quality of the people you need is critical. We now have all of this structural advantage in place with proven unit economics and cash generation. The market has been moving online since we started 24 years ago, and it continues to do so, with each generation more digitally literate than the last. And so, We see continuing structural market changes remaining in our favour, especially as over 95% of shopping journeys for electricals begin online. Our conviction that customers will always want better service, delivered faster and for less, enables us to invest heavily behind these brilliant retail basics with great conviction that they won't change. And our structural cost advantages of a fundamentally more cost-efficient model with our capability and scale, combined with our founder-led day-one mentality, positions us extremely well for the future. And with that, over to Mark to kick off our FY24 results presentation.
So, we first set out our strategy to pivot to profitability in July 22, and I'm pleased to present the results for the year ended March 24, which demonstrate the output of this strategy. Importantly, during the year, we've also been taking action to return us to growth, and in the final quarter, AO.com returned to revenue growth. We delivered our record ever group adjusted PBT of 34 million, up 22 million on the previous year, which is now at 3.3% of revenue. EPS was 4.29p per share, up over 380% year on year. And we're progressing towards our medium-term PBT target of 5%. Going forward, I expect revenue growth will leverage overheads to improve this metric further. Gross margin has also improved and is now just over 23%. This growth comes as a result of the increased MDA product mix, as well as an increase in the average product value, which has improved the amortization of delivery costs. This is further supported by our performance of our product protection plan customer base and is on top of the benefit from delivery charges and range rationalisation, as well as further efficiency savings in our logistics operation. There are some headwinds going into FY25 as latent inflationary pressures materialise, and we're working hard to mitigate the impact. Our cash has converted well to profits. CapEx was in line with our plan, albeit the decision to buy affordable mobiles and buy mobiles was an unforeseen opportunity. The actions we've taken to improve profitability resulted in a net revenue decrease year on year of about 9%, albeit AO.com grew in the final quarter of the year. Our MDA market share remains strong at over 15%, and the market's down about 1% year on year, which we anticipate is the bottom of the cycle. The increase in service revenue is driven mainly by the introduction of delivery charges and membership income. Commission revenue is made up of product protection plans and mobile phone contract sales. Our product protection plan customers continue to recognise the value and peace of mind it represents, and the volume of plans fell in line with retail sales, but the retention of customers improved, which has positively impacted profitability this year. Our mobile business has had a very difficult year. The new contract market was down about 14% year on year, which has been challenging as depressed customer demand placed volume pressure on our volume commitments to networks. With that suppressed market, competition for customers intensified, leading to increased expenditure in the acquisition of customers through affiliate channels and unsustainable discounts to try and achieve volume targets. Mobile remains a key part of our strategy. However, we could not feasibly continue to trade under the conditions seen in 2023. Therefore, at the start of the calendar year, we reset our approach. Firstly, we re-engineered the business in partnership with the networks to remove the dysfunctionality so that our goals are aligned. And secondly, we strengthened our market position with the addition of affordable mobiles and buy mobiles. And we expect this to reduce the pressure on acquisition costs and to be a source of natural traffic. And then finally, we continue to leverage our logistics and recycling network for third-party customers, where it doesn't distract from our core business. The actions we've discussed before on range and profit rationalisation helped us to deliver record gross margin at 23.4%, with margins in H2 being similar to H1. We've discussed that the mobile business has been impacted by a shrinking market and the resultant competitive pressure, which has had a negative drag on overall margin. This was offset to some degree by the improvement in retention in our product protection plan base during the year. And we're committed to growing our retail business, and the improved customer offerings through finance, membership, new categories and so on will be a key part of that growth. And John's going to explain the strategy for that shortly. This changing mix will result in a slightly dilutive impact to gross margin in the coming financial year. So turning to our SG&A costs, we've delivered savings of 19 million year on year and on a 2-year basis of 65 million, firmly demonstrating the output of our pivot to profit. For the long-term benefit of the business, we have continued to invest in marketing, although we have changed the focus of our spend away from direct acquisition towards brand investment as we look to cement our most trusted positioning with customers. As previously mentioned, the dynamics in mobile resulted in an increased cost of acquisition, which we don't expect to continue on a go-forward basis. In warehousing costs, we've delivered a number of efficiencies, which have contributed to us delivering not only a cash year-on-year saving, which you would expect with the decline in sales, but also an improvement in efficiency, as we have reduced the cost as a percentage of sales too. Our overhead control has continued, with a year-on-year saving of about 9 million. The nature of some contracts means there has been a lag in the increase of some costs, where inflationary pressures have continued to materialise despite the fall in the headline rate of inflation. We've experienced this as we exit FY24 and enter FY25, and government policy on minimum wage is driving high wage inflation in some of our lower paid operational roles. We've also invested 2 million in the year in the first stage of our ERP implementation. The investment will continue and increase slightly in the coming 2 or 3 years as we ensure our systems and processes are resilient and scalable for future growth. So we've talked through our revenue and our cost lines, and I'm pleased with the PBT output, which shows year-on-year growth of 22 million, delivering PBT of 3.3%, which is up 2.2% versus the previous year. We remain focused on efficiency savings as we now turn our focus to growth. So profits converted to cash during the period. The swings we witnessed in working capital over the last couple of years have now normalised, and we've chosen to make some investments in inventory as we look to maximise availability for customers. This is particularly in slow-moving products, as well as those where manufacturer lead times can be long or inconsistent, and as a result, stock days have increased to 43. We've seen a cash inflow of about 28 million as a result of the reduction in trade receivables and the receivables of the mobile business, as well as tidying up the legacy of B2B. Trade and other payables have also fallen year on year. Now, this is largely a timing impact in the mobile business as purchasing cycles align themselves to sales. Investment in CapEx was 8 million during the year, with the key assets being the site for our recycling operation in Telford and the acquisition of the mobile IP. Now, we do expect to see CapEx increase into FY25 to about 11 million, and the increase largely being the purchase of vehicles, which are in their normal renewal cycle, but we will now likely buy those rather than we'd previously leased them. We've extended our £80 million revolving credit facility by another year to April 27. This is on the same terms with our existing partners, and it's undrawn at the end of the year. As we exited FY24, we saw AO.com return to growth and expect this trajectory to continue in the coming year, and John's going to cover the strategy for this shortly. We will continue to leverage the fixed costs in our business, although we do expect to see some short-term inflation, which we'll proactively manage. Our expectations for the coming year is to deliver double-digit growth and adjusted PBT between about 36 and 41 million. And our medium-term aspirations remain unchanged, to improve PBT margins towards 5%, to grow our revenue in double digits, and to grow our EPS faster than revenue. And on that positive note, I'll pass you to John.
Okay, so as you've just seen in Mark's section, we've made real progress in improving our profitability, and this is going to be a continuous journey, but the heavy lifting of that is firmly done. And with the benefit of hindsight, while many businesses were paralysed by issues like working from home and cost inflation, and I think a lot are still waiting for that storm to pass, we're really glad that we had the courage of our convictions to take early, decisive action. And I think that's the advantage of living through 24 years of storms, that you really do learn how to dance in the rain. That said, the depth of the effort in getting to here should not at all be underestimated, and I'm really grateful to the entire AO team, our supplier partners, our shareholders, for everyone's support over the last 18 months as we've gone through the journey. As a result, we've ended the year a much simpler business in a steady state, performing better than ever for customers with outstanding unit economics, and crucially our culture, which underpins everything, is firmly back and even stronger than ever post-COVID. That's not to say that we won't get more profitable from here with growth, but the business foundations are now good, which is evidenced by today's numbers. Looking forward, our ambition is to be a double-digit growth business every year for the next 5 years. Now, I know it's easy to be sceptical about this, especially in the current economic climate. So I just want to spend a little bit of time setting out the broad plan that underpins our confidence to achieve this ambition. Our approach is based entirely on self-help, taking share by offering customers a great proposition in a broadly flat market, which will create operational gearing, and any replacement cycle that may come from the COVID peak, that'll be incremental. For context on the opportunity, our current share of the MDA market is around 15%, give or take, and yet our share in all other categories is around 2% or less of the market. To manage your expectations though, up front, we won't be releasing all the micro details about our plans. Our overarching strategy is to create an even more loyal customer base and win a better share of wallet from total household spend in the electricals category. And we have a number of mechanisms to achieve this with a range of customer cohorts. During the COVID period, we transacted with around 3 million new customers, and they all had a fantastic first-time experience with AO and with our brand at a time when they really needed us. We believe, and we're seeing, that they continue to repeat and buy new categories from us. And it's really important that we're already seeing this. We've taken the first steps in improving our proposition and fixing the unit economics of those other categories as well. Outside our MDA heritage, we're competing with a broader set of retailers, both online and in-store, where the reality is today is that we don't have an obvious right to win in those categories. So what are we doing about that? Well, let's start by looking at those customer cohorts that we can build and how we can drive loyalty to AO. So, finance customers, well, they give us a greater share of their wallet across categories, and they shop more frequently. That's because once they've gone through the process of opening a credit account, it's more convenient for them to shop with us, and of course they already have the reassurance of knowing that they have access to that credit. We've been building our finance base, which currently stands at just over 500,000 active customers, and they have about £750 million available to spend on their accounts. We now also have a growing AO membership, and that base pay £39 a year for the benefit of free delivery, free recycling, and great member deals. Those members are already demonstrating a willingness to give us a greater share of their wallet, giving us a clear right to win with them across new categories. Similarly, in our insurance business, we now have over 1 million customers paying us a monthly direct debit and trusting us for their peace of mind. And members with both finance accounts and insurance give us an even greater share of their wallet. In our mobile business, we now have over 1.1 million active customers, and members who have finance accounts, insurance products, and a mobile phone, well, guess what? They give us an even greater share of their wallet. So I'm sure you can see where I'm going with it. The further that we deepen our relationship with customers at scale, the greater our right to win a bigger share of their wallet. And so the more our unit economics improve. In turn, this enables us to keep investing in the reasons for customers to share that wallet with us. All the data that sits behind this is clearly extremely commercially sensitive. So today, I'm really just outlining the principles of the flywheel that drives what we think of as our shared economics model. And this enables us to share those unit economics with customers and to share value creation with investors. It also allows us to deepen our relationships with suppliers through a greater ability to directionally sell products to our members. Plus, from a people perspective, playing for a winning team it's just a lot more fun than battling relegation, which is hugely rewarding for all AOers who thrive in that high-performance, fast-paced culture. And ultimately, it's the data that we can see building behind all that and the compounding effect of the customer cohorts that underpins our confidence in the ambition of double-digit growth. And as Mark's alluded to, we also believe there's possibly a medium-term tailwind on the horizon as well, because of the amount of volume that was pulled forward into the COVID lockdown period. For context, MDA volumes were 16.2 million units in 2020, 15.4 million units in 21, compared to only 12.9 million units in 23. Now, our planning assumes that we stick with today's historically low volumes and that they will continue in the short term. But we are now 4 years from the start of the COVID spike. And even with slightly longer purchase cycles of electricals, it does seem reasonable to assume that there will be some growth returning to the replacement cycles from those COVID peaks 4 years ago in the not too distant future. As ever, none of this is going to be absolute plain sailing or a perfectly smooth journey. And our desire to keep driving at AO speed and keep innovating will create oscillations on the trajectory of our growth. But equally, the long-term trend will be upwards, just as it has been for the last 24 years. And building these cohorts will take time. It requires lots of lessons and learnings, and it'll also occasionally need investment at times, I'm sure. There will also need to be occasional leaps of faith and an unwavering commitment to the cause. But I am more convinced than ever that this is the best strategy to create value for everyone, from shareholders and customers to our people. And amidst all the talk of strategy, I don't want anyone to take for granted the brilliant retail basics that are so crucial to our business and will continue to underpin our success. And that's why we continue and always will obsess about them every day, be that range, price, delivery, speed of delivery, availability, delivery execution, delivery with a smile, installation, and always being there for customers with a human touch. That obsession recently manifested itself in us passing the 500,000 Trustpilot reviews milestone, with a trust score of 4.8 out of 5, meaning that AO is now the biggest scale Trustpilot retailer in the UK with the highest quality rating. That's a really, really, really proud moment. And frankly, it's the scorecard of just thousands and thousands of hours of great customer service lessons. And all this forms the foundation for that very simple message that we are, as you all well know, the UK's most trusted electrical retailer. We have a firm conviction that the need for those brilliant retail basics is not going to change anytime soon. And that means that we can really continue to invest in them with confidence. Plus, as I've said many times before, the reality is that the best service is actually no service. It should all just work. And it's also the most profitable service because every intervention costs money. And you've seen that in the results today. And all of this, in turn, gives us a clear structural advantage over time through the trust that it will generate with customers and other stakeholders. And so with that, I'll finish where I started by reiterating our confidence, which I hope some of you will now be more inclined to share a little of. That AO will be back to double-digit growth every year for the next 5 years. And with our medium-term PBT target in excess of 5% and having all that manifest into what I think of as just good old-fashioned cash.
If you continue to deliver on your current strategy, you'll actually be building a reasonable cash balance. What would be your plans for this money?
Hi, Hannah. Well, so in simple terms, the first priority is to make our balance sheet bulletproof. And then when we've achieved that, we'll look at best uses for that cash at the time.
Yeah, and I think, you know, we're 12 months or so away from that, but I think this time next year you can expect to start to speak more about our plans for what to do with that cash.
Thank you. Obviously, an initial look at the mobile results doesn't look positive. Obviously, your explanation now gives us some picture of what you're hoping to achieve, but can you expand on what your ambition is in this area and what the time horizons look like for a more positive outcome?
Yeah, sure. I mean, we said back in November last year that we wouldn't continue with our mobile business if we couldn't see line of sight to profitability and cash. And as we went through the pivot to profit, that was very much the lens that we looked at all the opportunities through. And we said if we couldn't achieve that, then we wouldn't be in the mobile business. We think it's really important strategically, and we now have clear line of sight to profitability and cash for the year ahead. We've worked really hard and really closely with the networks to completely re-engineer all the agreements with them, so that we now win together, and it's much more of a partnership relationship as we go forward. Clearly, in January, we opportunistically we got the ability to buy A1, which was Affordable Mobiles, and Buy Mobiles, which one takes some heat out of the market as both businesses were bidding against each other and bidding on each other's brands and driving marketing costs up and so on. So, that's turned out to be a great investment that we're really happy with. It's one that we did quickly. It was only a few million quid, and we're really happy with how those businesses have come together. So, mobile is a really important product and category for our customers. It's the product that people use most, care most about, and obviously it has a monthly billing platform, which gives us more contact with customers. So, we look forward to bringing better mobile deals for our members as we go forward.
Brilliant. Thank you for that. The decision to outsource fulfillment on your non-MDA, how can you be sure you'll hold on to your good Trustpilot ratings when you're relying on others for a large part of the service?
Yeah, I think it's fair to say that the front end of that service, we've not really changed that much, because if you'd bought a kettle or a vacuum cleaner from us 3 years ago, then that would have still been delivered in the main by DPD as our carrier partner. They're very good at what they do. And all our systems and processes support that if anything goes wrong. What we've really done is re-engineer the back end of that. So we've now got an automated warehousing operation around that, and we're piggybacking on the capital investment that DCC have put into that. That's been quite an integration for us from an IT perspective, so it's taken a bit of time to get that in. So it's more about sorting out our unit economics to be able to sell those products profitably at the sort of lower price points. We don't expect it to have any negative consequences for the customer service, other than positive, really. That it will enable us to sell next day delivery much later across a wider range of those products, and it'll enable us to be more competitive now we've got vastly improved unit economics on it.
Okay, thank you. Growth in the non-MDA categories like the SDA and electricals, with that now coming through, are you seeing much evidence yet of customers who come for the electricals returning and buying MDA too?
Yeah, I think it's fair to say that all categories cross-pollinate into all other categories. White goods is still our biggest origination, if you could think about it that way, category. But people that buy washing machines then go on to buy TVs. People that buy TVs buy washing machines. People that start off buying a coffee machine go on to buy laptops. And so we get the compounding benefit of that as those new categories grow. So yeah, absolutely. But it's not data that we release. We just consider that to be commercially sensitive.
Okay, perhaps segueing on from that then, the membership initiative looks interesting. Are you aware of any of your competitors doing anything similar? And following on, what evidence do you have so far of a percentage increase in basket size and or repeat visits?
So on direct competitors on what they're doing, so some companies have got membership schemes. Amazon as a direct competitor clearly have Amazon Prime. And, if you look at Costco, they have their membership scheme. And we've learned a lot from both of those businesses on how to drive this. So we think it's really important that the customer pays for membership. And the customer, therefore, is both economically and mentally invested in wanting to amortize that cost and extract as much value from the membership as they can. We are definitely seeing that members spend more, and we've called that out today, and they spend more across newer categories. Our market share for members in newer categories is materially higher than non-members, but we don't release any of the basket size or data around that. Again, we see that as commercially sensitive. But the coming together of customers that are members, customers that have finance accounts also purchase more and transact across categories with us. So it's about that deepening of the relationship, not with one silver bullet, but with many actions that we're undertaking. And it's the data that we can see behind that that really gives us the confidence to give the forecast that we have on the guidance for double-digit sales for the year ahead. And let's not forget, we are pretty much now at the end of Q1. So, we're pretty clear on what Q1's turned out at to be guiding for double-digit for the full year.
Great. You talk about reducing the unit cost economics. Is there any scope to drive these even lower?
Sure, do you want to take that one?
Yeah, I mean, I think there is sort of right across the business. I mean, I obviously called out in the presentation, we are short-term seeing some cost headwinds, and at the moment, what we're doing on driving efficiencies is offsetting those headwinds. But I do think there is further for us to go on those cost savings, which we would see as an ability then to take those savings and help invest in our membership proposition for our members.
Yeah, and I think it's fair to say, Hannah, that we'll see that, exactly where it ends up. I'm not really sure. I see it probably as, in a corridor of 5 to 8% of PBT. And after that, we will want to reinvest. We'll put a ceiling on that at some point, and we'll reinvest everything back into the shared economics model of whether that is further driving our finance business, maybe through subsidizing some promotional finance with things like interest-free credit, or whether that's more member pricing, or whether that's giving better deals on handsets with phones for those different cohorts. So, we very firmly see 8% as a sort of an almost absolute ceiling.
Yeah.
But exactly where we decide for that to settle out is we're undecided on at the minute. But if you look at our overhead, if you look at our operational gearing, we have our central overhead is 11% of sales. And so as we drive the growth, it doesn't quite halve if you double the business, but if you were to double the business overall, that 11 probably settles out at 6.5, something like that. And so immediately add that to where we are today, just through the operational gearing gets you through that threshold. And there's lots of other operational efficiencies to come with that growth as well. So it's all there. There's loads of fuel for us that's in our own hands to fuel that flywheel as we go.
Nice to have levers to pull. You have stated a target of 5% PBT margins. Do you think there is scope to drive these even higher?
Well, I think that's
I think we've sort of just answered that, which is we think we can get to 8% and reinvest them.
But it will be a journey because we want the business to be building steadily, and we want to, I talked in my presentation about, look, it'll never be straight line. There'll be oscillations on it, but we want it to be as predictable as possible, because the more predictable it is and the more joined up it is and the more organized it is, the more profitable it is on that journey.
Well, I have the benefit of having watched this presentation twice now, but I certainly know there were some interesting comments made earlier around the opportunity to not only obviously grow margins, but also the decisions to be made around margins versus market share and pulling out further growth.
Yeah, sure. And we've got an education piece to do with our customer base. We have a big ticket product that we sell that isn't a frequent purchase. We don't have the cadence of grocery shopping or something of that ilk. And so it takes time to educate customers. It takes time to grow that customer base. So, we've now transacted with over 12 million customers. We put 3 million new customers in the business through the COVID period, and we can now obviously see how they're performing and what our share of wallet of their spend is. Even in the last financial year, we put another 600,000 new customers. And so you can think of those, because of the levels of service and experience we deliver to those customers, you can think about those 600,000 customers as seeds for future sales, if you will. And so that flywheel takes time to build and to get to scale. But we are now at scale. You know, we're the fastest electrical retailer in the UK ever to get to 1 billion of sales. And that was never going to be straight line either. And so, you know, people call out the things that we've stopped doing, but there's a lot of things that we've kept doing and we're doubling down on. You know, going from 0 to 500,000 finance customers with, you know, 750 million available to spend on their accounts, we can market directly to those people. And so they are much more profitable customers because we don't have customer acquisition costs with them. And so again, as you get through those thresholds and tipping points of building those cohorts, the flywheel really starts to spin.
Well, there's a follow-up question on that basis, actually. You talk about the finance opportunity. Do you think that explains some of the reason for Fraser's interest in AO?
No, not particularly. I think that Fraser CAO is a fantastic investment. The conversations were in sort of germinating through many years. And we don't use Frasers Plus at the minute. You know, we have a strategy and we have a partner in New Day that we're building. There's nothing to say we can't look at Frasers Plus. We're not kind of positive or negative on it at all. I think, you know, Mike is pretty shrewd in retail investments that he makes, and he sees very little downside in the investment. And I think, you know, that's been borne out. He's done pretty well so far, I think.
Absolutely, as those who I hope are listening today and shareholders. But that is it for the questions. That just leaves me to thank you all for listening in. Thank you, gentlemen, for taking the time to answer the questions. And we look forward to hearing of further progress in the next 6 months.
Thanks, Anna.
Great, thanks, Anna.